Hi, today our topic is Managerial Economics in Operation Management, Semester 1. So, Managerial Economics can be defined as a amalgamation of economic theory with business practices. So, as it too is decision making and future planning by management. So, managerial economics assist the managers of a firm in rational situations of obstacles faced in the firm's activities. So, it makes uses of economic theory and concepts also. It helps in formulating logical managerial decisions in organizations. So, the key of managerial economics is the microeconomic theory of a firm. So, it lessens the gap between economics in theory and economics in practices also in organizations. So, managerial economics is a science dealing with effective use of scarce resources. So, it guides the managers in taking decisions relating to the firm's customers, competitors, suppliers, as well as relating to the internal functioning of a firm. So it makes use of statistical and analytical tools to access or assess economic theories in solving practical business problems also. So study of managerial economics helps in enhancement of analytical skills, assist in rational configurations as well as solutions of problems, while microeconomics is the study of decisions so made regarding the allocation of resources and prices of goods and services. Macroeconomics is the field of economics that studies the behavior of economy as a whole. So that is entire industries and economics also. So managerial economics applies microeconomic tools to make business decisions. So it deals with a firm to use of managerial economics is not limited to profit making firms and organizations. So, but it can also be used to help in decision making processes of non-profit organizations. For example, hospital, educational institutions, etc. It enables optimum utilizations of scarce resources in such organizations as well as helps in achieving the goals in most efficient manner. So managerial economics is the one of the great help in price analytical also, production analysis, capital budgeting, risk analysis and determination of demands also. So managerial economics uses both economic theory as well as econometrics for rational managerial decisions making. So econometric is defined as use of statistical tools for assessing economic theories by empirically measuring relationship between economic variables. So it uses functional data for solutions of economic problems. So managerial economics is associated with the economic theory which constitutes the theory of firm. So theory of firm states that the primary aim of the firm is to maximize the wealth. So decision making is managerial economics generally involves establishment of the firm's objectives. So identification of problems involving in achievement of those objectives, development of various alternatives and solutions. So selection of best alternatives and finally implementation of the decisions. So the following figure tells the primary ways in which managerial economics correlates to managerial decisions making also. So now we discuss about the managerial definition decision use issues, economics theory and concepts which demand, supply, cost, complementing and competition of markets and quantitative approach, mathematical economics, econometrics and managerial economics using both economic theory, concepts and quantitative approach to make managerial decisions making. So now we discuss about scope of managerial economics. So managerial economics deals with allocating the scarce resource in a manner that minimizes the cost. As we have already discussed, managerial economics is different from microeconomics and macroeconomics also. So managerial economics has a more narrow scope. It is actually solving managerial issues using microeconomics. So whether or whenever there are scarce resources, managerial economics ensures that manager make effective and efficient decisions concerning customers, suppliers, competitors as well as within an organization. The fact of scarcity of resources gives rise to three fundamental questions. First, what to product? Number two, how to produce? Number three, for whom to produce? So, to answer these questions, a firm makes use of managerial economics principles. So, the first questions related to what goods and services should be produced and in what amount and quantities also. The manager used demand theory for deciding this. So the demand theory examines consumer behavior with respect to the kind of purchases they would like to make currently and in future. The factors influencing purchase and consumption of a specific good for services. The impact of change in these factors on the demand of that specific good or services also, and the goods of services which consumers might not purchase and consume in future. So in order to decide the amount of goods and services to be produced, the manager use methods of demand forecasting. The second question relates to how to produce the goods and services in organizations. The firm has now to choose among different alternatives techniques of production. So it has to make decision regarding purchase of raw materials first, capital equipments, manpower, etc. in organizations. The managers can use various managerial economics tools such as production and cost analysis for hiring and acquiring of inputs. So project appraisal methods for long-term investment decision etc. for making these crucial decisions. The third question is regarding who should consume and claim the goods and services produced by the firm. So the firm, for instance, must decide which is its the market, domestic or foreign. So it must segment the market, it must conduct a through analysis of market structure and thus take price and output decisions depending upon the type of market. So it may be local market, that is domestic, or it may be foreign market, that I already mentioned. So managerial economics helps in decision makings as it involves logical thinking also, moreover by studying simple models. So managers can deal with more complex and practical situations. So also a general approach is implemented. So managerial economics take a wider picture of firms, that is it deals with questions such as what is a firm, what is a firm, what are the firm's objectives, and what forces push the firm towards the profit and away from profit. In short, managerial economics emphasizes upon the firm the decisions relating to individuals, firms, and the environment in which the firm operates. So it deals with the key issues such as what conditions favor entry and exit of the firms in market. So why are people paid well in some jobs and not so well in other jobs, etc. So managerial economics is a great rational and analytical tools. Managerial economics is not only applicable to profit making business organizations but also to non-profit organizations such as hospitals, schools and government agencies, etc. that I have mentioned earlier. So managerial economics decisions, definitions. So as I earlier mentioned, that managerial economics is a stream of management studied that focus on decisions making and problem solving. Both microeconomics and macroeconomics theories are applied. It focuses on the efficient utilization of scarce resources. So it is a discipline that brings together the concept of business and economics, and it enables leaders and managers with relevant data, demand projections and capital management, pricing, decision, profit management, cost analysis and production analysis also. So the key takeaways of managerial economics. So managerial economics is the application of various economics measures, policies and principal tools, methods and theories to enable decision making, the problem solving. So it highlights techniques for efficient utilization of financial, human and material resources also, so that profits can be maximized in organizations. And it is a pragmatic and normative approach also. It solves a business internal, that is microeconomic problems, by analyzing macroeconomic threats and challenges in organizations. So managerial economics explained. So managerial economics analyzes the internal and external factors impacting of an organization. It aims to resolve problems using micro and macroeconomics tools. That it is a practical approach where economic measures are undertaken to solve business problems. In addition to solving problems, this approach extends to the growth and sustainability of a firm. So it is further classified into three subtypes, that is liberal, normative, radical. So first of all, liberal. The consumer demands, detects, markets, customers are free to make their buying decisions and choices. Normative. The administrative takes pragmatic decisions pertaining to cost management also, and demand analysis, production and advertising. Now radical. So the management adopts a game-changing attitude to prioritize customer needs, requirements and satisfaction over business profits. So the scope of managerial economics, the concept is implemented in the following ways that I mentioned right now. So managers apply microeconomics principle and theories to handle internal issues, that is production, sale and distribution, capital, pricing, profit, workforce, etc. So now production theory. In order to ensure high productivity with limited resources, microeconomics studies the impact of the production related decisions. So capital requirement, labor requirement, production capacity, processes, methods, techniques, cost and quality. Investment theory. Companies diligently plan their capital investments to ensure resource utilizations, generating higher returns in the organizations. Demand theory. To ensure consumer satisfactions, manager analysis consumer needs and requirement. They understand consumer attitude and responses towards company product or services. Market structure pricing theory. It involves price determinations and management. The business prices its products and services very competably to determine the price of firms and consider production costs also, market demand and marketing cost. Profit management. Profit maximization is the ultimate aim in the organizations. This approach focuses on cost and revenue also. So business operate in external environment, face unforeseen challenges. Macroeconomics deals with external challenges with the help of the tools like pestle analysis, and let's us first details now political about. So government plays a crucial or critical role in a firm progress. Thus managerial economics studies how government style, political unrest and foreign collaboration affect private sectors companies. Economic. Business profitability greatly depends on government policies, tax reforms, GDP and nation's economic stability. Social. The social environment molds business. This includes factors like societal values, beliefs, attitude, consumer awareness, employment conditions, literacy rate, and trade unions. Technical or technological. So technologically enhances the production and distribution of goods or services. Environmental. So when awareness of environmental concerns increase, the firm face pressures to adopt sustainable and eco-friendly practices. These includes the curtailing of populations, waste management or pollutions, preservations of water, and preservation of natural resources also. Legal. So businesses must operate within legal boundaries. National laws and pertaining to consumer rights, labor laws, health and safety laws, product labeling regulations, and advertising guidelines also. Nature of the managerial economics. So managerial economics has often been confused with traditional economics, but it has a whole new meaning of and purpose. So let us understand the distinction by venture deeper into its characters. So microeconomics, it solves the microeconomic problem faced by a particular firm, does not focus on the entire economy. So pragmatic managerial economic is a practical approach. It applies economic principles in decision makings and problem solving. Multidisciplinary, this approach aggregates multiple streams: business, management, accounting, statistics, finance, and mathematics also. Application of macroeconomics, every firm operates in an external environment influenced by legal, political, global, social, economic, technological, competitive, and demographic factors. So macroeconomics deals with all threats, management oriented. So it educates leaders and managers on how to make crucial decisions in crucial critical situations occurred in the organization also. So importance, following are areas where managerial economics plays a key play role. The companies use managerial economics for forecasting demands based on demand projections. Long-term business policies are formulated. The external environment poses various excellence and uncertainties. This discipline creates and estimates of those threats. As a result, firms can prepare themselves for damage limitation strategies. Inventory management, it is crucial for business. By employing demand analysis, firms can plan inventory beforehand. It facilitates the determination of the future cost of the business. Scarce resources can be utilized efficiently. These ways total cost of the production and sales can be mitigated. So this study aids top level management in making critical capital management decision, investing in the right venture. So thanks for watching my videos. If you like my videos, please subscribe my channel. Thanks a lot for watching.